Let's get to Tom Stevenson, and he's our investment director, guest host from Fidelity International. Tom, good to see you this morning. I started the show with sentiment. I was talking about the current index and the forward-looking. And the forward-looking index is under pressure. And I think for markets, this is perhaps the most telling chart that I've seen in a while, which is we're running out of confidence for the back half of the year. And that sets us up for a little bit more, perhaps, rumbling in the markets.
Yeah, absolutely. The first half of 2018 has been really pretty disappointing. It was always going to be a difficult challenge to live up to what we saw in 2017. It was a very benign environment for the markets, and really whatever you look at, growth, inflation, all the measures which investors look at have deteriorated at the margin over the first half of 2018. And then we add on to that the trade war fears, the rising oil price. Markets don't tend to peak until sort of 6 to 9 months before a recession, and that felt like that was, not the core, not the base case. That felt like that was some way off. It feels a lot closer now than maybe it did a few months ago.
We've been talking, and Manus was just asking Dan about it just there, and I was talking about it earlier. The extent to which we really understand what the Trump administration is trying to do with China and whether there are different voices speaking here. The Macro Man blog on the Bloomberg, though, I thought was really interesting yesterday, talking about how we now know the strike price of a Trump put. So he likes this feedback. He likes this sort of instant feedback on his policy, and he gets some of that from financial markets. If he doesn't like what he sees, maybe he changes course. That seems to be the conclusion that many are prepared to draw from this week, or is that too consensus for you, Tom?
No, I think what we've seen this week is that it is two-way traffic. The markets are responding to Trump, but Trump is clearly responding to the markets, but he's also responding to what he's hearing from business as well. I mean, I think we shouldn't sort of underestimate the impact of the Harley-Davidson move. I mean, clearly he was made nervous by the market reaction between Monday and Wednesday this week, and we've got used to Trump changing his mind, turning on a sixpence, and he did it again.
Can I ask you, I've put together this one, which is the performance in US equities. I said it at the start of the show, down 13 days in a row. Financials getting pummeled, and people are pulling money out of US financial ETFs. Big outflows, the biggest in 2 years. Would you hide in US stocks relative to the rest of the world in the event of an escalation of trade wars?
Well, that's extremely interesting question, because I do think that in the event of trade wars there will be a flight to safety. We're already seeing that in the action of the yen and treasury bonds. And yes, the US market is one of the world's priciest still, but there's a good reason for that. It is a relatively defensive market at times of geopolitical stress. And we're seeing, the impact on emerging markets, markets which are particularly affected by global trade. The European market, for example, Japan, they're extremely vulnerable to trade wars. And yes, I do think there is an argument for finding shelter, port in the storm, in the US market.